We are trying to create as much content to help people navigate the uncertainty. If you didn't see Sunday's broadcast, then never mind, you can either return to it, but I'm just going to be giving an update since Sunday. And the goal is really to get through as many of your questions. I'll set some content of what's been happening since Sunday in the financial markets. A few things to point out. My thoughts go out to anybody that's affected by the coronavirus or has had family members affected by the coronavirus. I personally, I'm not an expert on coronavirus. I'm just trying to take in the information as it comes from people that have much better information than me. A few things that I'm doing is I'm making sure that I'm using my alcohol disinfectant on my hands as frequently as I can, washing my hands as frequently as I can, not just to protect myself, but to protect others. And also, if I have to go out, then I was wearing the mask and some gloves, and just trying to eliminate contact from people as much as possible. I'm currently in the hotel on 4G, so the internet's not working too well in the hotel, so I'm on my 4G connection, and I'm in a hotel because the timing is very unfortunate. We're doing some building work on our house, and so I'm reporting here, giving content from the hotel. My goal with these sessions is just simply, I'm here with Famida from the Bank to the Future team. She's just going to be pulling out all of your questions and asking questions based upon those as well. That can be done on either Twitter, Facebook, or any of the other places where we're broadcasting from. Although Famida is from the Bank to the Future team, it's important to say that the things that I'm discussing are my personal opinions. They're not those of the company. And I'm just here to try and add some value, create some content, and just help people navigate the financial markets in these very turbulent and uncertain times. So what's happened since Sunday? Well, right after the broadcast, we had the announcement that the Federal Reserve have cut interest rates in the US on a Sunday to 0. A few really important things to understand about that. That essentially means that in order to re-stimulate the economy, they need their existing monetary policies that they'd like you to take on debt, they'd like companies to take on debt, and they would like banks to borrow at 0% and lend to you at a higher interest rate. So that just means that banks can borrow at 0%, or anyone that has access to the Fed borrowing. And then they can lend it out at a higher interest rate, and it's a not very effective monetary policy. But the real uncertainty in the market, so as soon as the markets got hold of the news, the stock markets immediately corrected. Now, what would normally happen in a normal market is that when the Fed takes such aggressive measures to re-stimulate the economy, you'd have a big pump in the stock market reacting to the news that this money is going to be injected into the economy. In this case, when the Fed takes out such monetary policy and the stock market crashes, it means that everybody's in complete uncertainty, and it's having the opposite effect. So we are now at 0 interest rates, which means that essentially a tool of monetary policy that the central banks use in order to prop up the economy has disappeared. So once you're at 0, the only place you can go is negative, which means that effectively it costs money to leave money at a bank, which certain economies are in that situation right now. And essentially what they're saying, and what the idea of that policy is that they don't want you to save any money. They want it to cost you money to save so that you go out there and spend. And if you go out there and spend, it can re-stimulate the economy. These are the monetary measures and policies that we operate our economy off, all because we've outsourced the ability to create money to the private banking sector. So that's the consequences of that monetary policy. You also have to ask the question, what is it that the government or the Fed felt was so urgent that they needed to do this on a Sunday instead of Monday? Normally, the last time that we saw such action happen on a Sunday was during the financial crisis. So how I interpret such information is that the government or the Fed feels that there's something so important in terms of liquidity between banks drying up that they felt they had to do it on a Sunday rather than wait till Monday. So you have to ask these questions, which can mean that a health crisis can turn into financial crisis and recession. Now, I'm not here to fear you. I'm here to tell you it as it is, so that then you can start to try and make decisions about what you're going to do and how you're going to react to the current policy. Really, my goal is just to give you more information and try and condense it down into normal language that everyday people can understand, rather than it coming through in the way that it does when it comes from the Federal Reserve. So essentially, that normally implies a liquidity crisis between banks. They have to cut the interest rates down to zero to try and re-stimulate and send out a signal. But it led to the stock market crashing, which is not really a good sign. The other thing is that bond prices, stock prices, gold, and even Bitcoin all corrected at the same time. Normally, you get a negative correlation. So if stock markets are crashing, then bond markets are reacting to the positive. But we're getting both of them crashing at the same time. So that's deeply concerning in terms of what it actually means for the economy. And essentially, it means that in times when the government is putting interest rates to zero, they're trying to re-stimulate the bond market, but people are actually not willing to lend to the government as well. When bond markets are crashing at the same time. Normally, you get a correction where money comes out of the stock market and into the bond markets. For those of you not familiar, bond markets means loans to governments. And this is how the government access capital, because they never collect enough tax to meet their liabilities. So they borrow the difference through the bond market. And normally the biggest investor in US treasuries are China as well, obviously. So it just highlights the deep interdependence that we have within our economy between the largest consumer in the world, America, and the largest exporter in the world, China. And as the supply chain starts to have effects, this is why there's uncertainty, exposes financial challenges, which can then lead to a recession. So I'm not here to tell you that the realities of the traditional financial system, and then we can cover questions around what people can do and how people can react once they have the information. What else did the Federal Reserve announce? What else did we see? The Fed was also agreed to start lending dollars to other central banks. So if other central banks want to borrow dollars, then they'll make those facilities available to certain central banks. Which again is another stimulus for trying to push more and more debt. So now it's going beyond just your own central bank and quantitative easing. We're now looking at how you can get other central banks into debt, into the Federal Reserve. So that's a new source of debt that we can add to the economy, because we've created an economy whereby in order to have an economy, you have to have more debt. So these are all stimulus designed to increasing the level of indebtedness in an economy that's already $250 trillion in debt globally. The other thing that's happening is the banks have actually moved. This is very concerning. Is a stimulus. The Fed has actually decided that banks now can remove all reserve requirements. So if you're familiar with fractional reserve banking, it means that you need to hold certain amounts of money on reserve before you can create new money by loans. And when they allow people to overcome those reserve requirements, it means that banks can leverage further if they choose, but then banks might not be willing to pay part in that. So is the government trying to get the banks to lend money to create new money and also remove those reserve requirements? Which may have short-term effects, but massive long-term consequences in terms of exposing the weakness of the financial system, and triggering that systemic risk event that I've always talked about in previous videos. The other thing is that quantitative easing has started again. Essentially, quantitative easing is the process of the central bank creating new money and investing it into corporate bonds. And corporate bonds means that the largest, most creditworthy companies are essentially borrowing money and paying a coupon. And what that means is essentially increasing corporate debt. So remember, when you have an economy that is based upon debt, you've either got to go out to the consumers and get them to borrow more money, or you've got to go out to companies and get them to borrow more money, or you've got to go out to the government and get them to borrow more money, or you've got to go to the central bank and get them to leverage their balance sheet, or you've got to find another central bank or another current country that will borrow. But the point is that the only way you can recover an economy that relies upon money created as debt is to create more debt. So quantitative easing is starting again. The problem with quantitative easing is it's no longer an effective stimulus. So essentially, this is laying the foundation for printing vast sums of money, which dilutes people's savings, which is a hidden tax, and essentially using the markets and the bond markets and the central bank's balance sheet in order to do that. The effect of that is that large corporations get access to money that they can then use to buy back their stocks and essentially perpetuate a Ponzi scheme, whereby it's pumping new money that is being borrowed from the central bank's balance sheet into creating fake markets and stock markets in order to prevent them from overinflating, which is what we've been doing for the last decade. So the price increases in the stock markets have been a result of access to cheap money, which is then being used to buy back stocks and allows the large corporations to profit rather than actually injecting that. So many monetary reform policies have been around. How can you use quantitative easing to actually get that money to the real people? And those are very valid things that I think will be discussed over the weeks ahead. In order to re-stimulate. If you're going to leverage the central bank's balance sheet, and you're going to get money into the corporate sector, then why not actually put that at at the lower levels of income and all sorts of other things. And then there's all sorts of interesting policies. So I don't just want to give you negativity and add to your fear and uncertainty in these troubling times. There are many reforms that can happen. And there's many policies that can be implemented, and we can cover some of those and take some of your questions during this call. My goal is to give it to you as it is, give you the reality, give it to you in plain English so that you can understand the effects and how these monetary policies are being implemented. And then you can also understand and appreciate that there's actually opportunities to fix broken parts of our economies, broken parts of our financial system. And use essentially a very negative crisis situation to actually drive some more sustainability into how we operate and manage our economy after creating this, what I call the world's largest regulated Ponzi scheme called traditional fiat money. Other things that are happening is we've done QE. The other measures that other countries are actually looking at is obviously negative interest rates. We discussed that one as well. In terms of solutions, what things can be done? So in my previous broadcast, I talked about how I believe that central banks are going to be using central bank digital currencies in order to allow banks to go bust and make sure that consumers and corporations don't lose their money by replacing the money at a bank, allowing the bank to go bust, and combating the deflationary effect of mass defaults on loans by replacing that money with a central bank issued digital currency. So these are all solutions that can be implemented. That is both non-inflationary and non-deflationary, because you're just replacing one form of money with another form of money and taking out all the interest rates of bank-created money that's all backed by debt. Another type of thing is that quantitative easing could actually be used to do something very good. So rather than actually using it in order to lend or to buy corporate bonds, the quantitative easing money could be used to actually do something very innovative as well. So one, suggestion is talking about, you'll hear about it over the coming weeks ahead, this whole concept of helicopter money, which is essentially just taking some of that money and dropping it to everybody through the banking system, or just giving everybody some kind of subsidy. So in terms of helicopter money, what if, rather than actually, so remember, if you use the opportunity of a central bank digital currency to replace the debt-based money that was created at a bank, which essentially is a digital currency created by a bank, backed by debt and operating in a Ponzi scheme. What if you could replace that and use a mechanism for replacing that money? Remember, one form of money replacing with another form of money, but actually distributing it in a really interesting way. So if you, for example, had a scenario where rather than bailing out a bank, rather than the disastrous deflationary effects, you could use that money to give everybody the ability to access a coronavirus test. I know that obviously there would be massive strains upon the healthcare system, and the governments would have to figure these things out. But that money could be redistributed in a much more fair and way that actually tries to solve some of these problems, rather than actually giving it to large corporations and perpetuating the rich-poor divide in times of uncertainty. I understand that the corporate bond market is a very easy thing to actually access and distribute fast. But again, a central bank digital currency could create the opportunity for that. And these things can all be looked at, whether the challenge is whether the healthcare system can sustain that, keep up with that. But if you're replacing one form of money with another form of money, it can be used for all sorts of things. Essentially, you're just swapping the credit risk of the bank for something that can actually help us during this time, rather than stimulating corporate bond market. Other solutions that governments have actually done, some of our team members in the Philippines, they said that the government have just simply stopped and closed the stock market, which is, again, it highlights what I've been trying to share in many videos over the years before it actually got to a crisis moment, that when you have not just assets with somebody else, you have these scenarios where a stock market can decide to just remove all liquidity, and that means that you're stuck in those stocks. They're trying to prevent it from crashing. Normally you get crony capitalism, whereby those that are the most connected to the markets have the ability to exit those things or do it over the counter trades, and then the retail individuals ending up in a scenario. So that can be highly manipulative, and I think it's a very ineffective way of kicking the can down the road a little bit further and starving people of liquidity in times when they might have wanted to sell those stocks in order to gain some cash in order to help. So I think that's a pretty ineffective strategy, because in other markets like the New York Stock Exchange and NASDAQ, they have these things called circuit breakers, which essentially means that the market closes if it crashes down 10% or 15% or 20%. To try and prevent, the mad rush of people that are looking to sell. That is one of the reasons why Bitcoin has gone down further than the stock market, and people are discussing this coupling of the stock market with Bitcoin. Well, Bitcoin doesn't have a circuit breaker, so if it's the price that you see is the real price at which people are willing to buy and sell. The prices that you see in the stock markets are the circuit breaker price, where the stock markets have stopped people from selling and stopped people accessing their liquidity. So therefore it's decreasing at a slower rate because of these circuit breakers, but it doesn't mean that it won't re-kick in the next day. So it's been a really, really busy time. And these are the things that have happened just since Sunday. So what I guess the situation that I'm trying to update everybody on is that while at the moment you've got to take care of your health first, and you've got to think about you and your loved ones in terms of what your approach is going to be, recognize that the things that we're asking and governments are going to be doing are going to have negative effects in the future in terms of the financial crisis. And that's when I think that Bitcoin is negatively correlated, is my bet. Whether this happens or not, we're about to find out. But rather than negatively correlated to a stock market, I believe it's negatively correlated to a financial crisis, looking at the events of the past, which have stimulated people looking to put some of their funds into money that you can own, money that you can spend, and has a fixed money supply. So all of the actions that we've seen, the governments are taking with traditional fiat currency, are the exact opposite effects that can happen in the Bitcoin market with the fixed supply that can't be changed with these things. So there's a bunch of things that have all happened. So I think at this stage, let's head over to your questions again so that we can try and answer as many of your questions as possible during these times. So Famida, have you got some questions that might have come from the viewers?
Yeah, I do. Just bear with me. I'm just gonna look at the list. We've also got so many left over from the last live that we did the other day.
Yeah.
Okay, so Simon, if the rates go negative, is that bullish for Bitcoin?
Well, it's very hard to say cut and dry answers, because you're dealing with two forces at the moment. One is a movement away from speculation. So a vast majority of people that purchased Bitcoin did it for speculative reasons to make money. So as we reach times of uncertainty, then people tend to exit speculative things in order to drive themselves to cash. But when cash is offering negative interest rates, then I believe a percentage of people that will be looking at what they can do, because it's costing them money to leave their funds at a bank, people will actually start to question, as well as people, when money supply is increasing, they'll start to look, once the dust has settled, at what types of things they can do to counter that. And Bitcoin is just one of those things that can do, which has the exact opposite effect. So I believe it's going to take time for people. The reason that we're not seeing these effects so directly correlated is because there's so much misunderstanding in terms of what Bitcoin is, how it works, and people's ability to grasp these concepts. So there's a differential. The time frame in terms of the differential, I believe, is a function of people being maybe in Bitcoin for the wrong reason, those people having to exit crypto or Bitcoin, and then people realizing what Bitcoin was actually designed for, and having real adoption based upon the real use case and some of the things that Bitcoin can fulfill. So I would suggest that negative interest rates, potentially, in all things being equal, depending on the health crisis, can have a positive effect on Bitcoin once the market has time to react and figure out what is going to happen to all these cash reserves from the money that's actually exited the stock market.
All right, thank you so much. So the next question I have here is, do you think hyperinflation is is on its way as the Fed is injecting fiat?
So one of these things that I talked about in the last video as well, and other videos, is this whole concept of economists. Our monetary policy is based upon economic models that have been dreamt up in the academic world, obviously backed up by empirical evidence, but they've never actually been resolved. We have different schools of thoughts in economics, and it's never actually been decided which one is the right way. The government converged upon Keynesian economics, and Keynesian economics is the process of believing that during times of bad economies and recessions, the government should take on debt and the government should stimulate the economy. And then during good times, the government should pay down the debt and actually borrow less. The problem is that what they do with Keynesian economics is they use the troubling times to borrow the money, increase the debt, and then in the good times they increase the debt as well, rather than paying down the debt. The reason is because it ignores the properties of how money is created, and money is created by debt, not through a multiplier effect. It's actually created, by banks' ability to lend money. So this also always has, the opposite effect of just increasing debt, and plus you have more debt than money in the economy. So that's the classic definition of a Ponzi scheme. So in terms of, I've forgotten the original question. What was the original question?
Do you think hyperinflation is
Hyperinflation.
on the way? Yeah, because of the fiat injection.
Got you. So traditional monetary policy will tell you put interest rates down during times of uncertainty so that people borrow more money. And when times are good, put interest rates up so essentially you can send the people that borrowed the money bankrupt and cool down the economy to try and combat inflation. So the way that monetarists and Keynesian economics use monetary policy at the moment is increasing the level of indebtedness, increasing the money supply by stimulating debt, which can, in theory, lead to hyperinflation. But in times of uncertainty where people are exiting their assets, essentially has a deflationary effect at the moment. And then you're trying to wrestle which one of those deflation, inflation. What tends to happen is you tend to have deflation that's then followed by inflation. And if the policies get too reckless, then you can end up in a really disastrous effect like hyperinflation in countries that have experienced that, where essentially your savings get depleted to nothing, which is a really, really disastrous and horrific effect on people, and something that I wouldn't wish upon any country. It is to be avoided. What I think is more likely to happen is we need to use, if we continue our existing policy, if we listen to traditional economics and continue with exactly the policies that we have been utilizing, then Keynesian economics will inevitably lead to that hyperinflation environment. But what we can do is, if we can actually use this opportunity to get a monetary reform in place, whereby you replace one form of money with another form of money, reducing the debt burden and allowing for competition with currencies like Bitcoin, which are apolitical and not dependent upon one country, then you can start to have a really, really interesting opportunity to take away much of the crony capitalism that happens in the banking sector, and make sure that consumers don't lose their money, and also have a neutral effect whereby it's not inflationary because you're not increasing the money supply. Inflation, I believe, and empirically, is essentially factoring in the level of interest that you have to add on top of money. So imagine you've got all this money in the economy, but you add on top of that all the interest that needs to be repaid. As the money supply increases, you have higher and higher level of interest. So as you add more and more interest in the economy by increasing the level of indebtedness, then inevitably companies that are trying to pay down their debt have to increase their prices, and then people have to borrow more. Their rents increase because 40% of all the money is being used to pump up the property markets. People are trying to get on the property markets to try and beat inflation, and you have this real vicious cycle. Because I believe that this real inefficiency of factoring in, by combining debt, money creation with debt, you have to factor in all that interest, which I believe has a really inflationary effect. And some of the Ponzi scheme like properties that we refer to. So the potential for hyperinflation is there, especially with these new stimulus of money. But I believe that we need to have a radical reform, or you need to continually use financial engineering to create new levels of indebtedness, which can combat some of that effect. But the headline inflation numbers that you see can't be trusted upon, because it doesn't include half of the realities of an individual. If you want to know what real inflation is, just sit down and speak to somebody. They're in a situation where they need their partner, they need their children to work in order to just live a household, whereby it used to be that one person could bring up a household and everybody could focus on other things. If you speak to the average person on the street or anywhere really, just think of yourself. Do you feel like your costs are going down or going up over time? Well, most people believe that it's going up, and it's certainly not by 2% per year, because it's not factoring in some of the biggest effects of which is that most of our money is spent on mortgage or rent, and it doesn't even get factored into the inflation numbers that we get. So you can't even trust the real numbers. It's a bit like this crisis right now. You know, you have to trust that the numbers that you're getting are the right numbers when there's such a disincentive to report the real numbers because of the economic consequences for the economy. So it's a challenging thing to think, but my guess is that there's a real threat of eventually getting into hyperinflation, but instead they'll use financial engineering to prop up the system. Or my more optimistic approach is that they'll use financial engineering to do radical monetary reform. And whichever one happens, there is a counterforce called Bitcoin, which is a fixed supply, apolitical, that people can decide to choose between their traditional fiat currencies and things that will operate outside of the traditional financial system.
Yeah, actually, Simon, just going off from what you just said about hyperinflation, I'm curious, do you know of any countries that have gone through hyperinflation and actually recovered?
Yeah, I mean, Germany is a classic story. So the post-war Germany was, there's classic pictures all around of people burning their money in wheelbarrows because they were using it to heat their rooms, because the money that they had as paper money was worthless and they couldn't be used to make any purchases. There are many case studies out there of recovering from hyperinflation, but it's normally followed by so I talk about radical monetary reform throughout history. Every 50 years we've always seen ginormous monetary reforms, but what we're seeing right now is that instead of doing monetary reform, instead of moving to sound principles and using the principles of sound money, we've been using financial engineering to prop up a system that they refuse to allow to deflate. So yeah, there's plenty of stories of those case studies, but it normally requires a whole nation to wipe out their savings, which has extremely negative consequences for the people that are plagued by such. It really is a horrific thing that I don't wish upon any country or anyone.
Great, thanks for that, Simon. So the next question I have here, actually, it's about one of our pitches, and I'm not sure whether you can discuss it, but somebody's asked about layer one and if possibly the crisis that we're in right now is the reason for why it's been quite a slow uptake.
So I was doing this on my personal. I'm not, I'm really not here to push any of the things that we're doing at Bank to the Future. I'm trying to just be of service to people that are going through these specific scenarios. So if you want to discuss anything to do with Bank to the Future, then please use the private investor forums or the support channels. I don't think this is an appropriate medium to start discussing things like that.
Thanks, Simon. Oh, okay, so next question I have here is, what happens to personal debt if the system goes to a non-debt based system?
So people get very confused by this one. They believe that people confuse debt with money created as debt. Let me say that again, because it's a really strange, obscure concept for people to get their heads around. There is nothing wrong with debt. Debt is a perfectly valid way of redistributing money from those that have savings to those that want to borrow at times of different stages of their life. So peer-to-peer lending, there is no major problem with people wanting to receive interest on their money and people wanting to borrow in order to meet certain liabilities or situations in responsible lending environments. The problem is money created as debt. Whoever's idea it was to combine money creation with issuing loans created the Ponzi scheme that we live in today. So what happens today is that when you borrow the money from the bank, it's not somebody else's savings like people might think it is. It's brand new money that's created a new digital currency called the digital dollar or the digital pound, which is a representation of the government's money, which is what they print, physical notes and coins. There's a video if you really want to understand these different types of money. I created a video on my YouTube channel called I think it was 6 types of money and how they work and how they're created and who profits from them. So if you are really interested in these different types of money, then check out that video, 6 types of money. And I go through all the different the most major types of money, how they're created and who profits from their creation. But money that was created at a bank, the bank profits from. So what we have done right now is we decided that it was a good idea to combine a free market solution essentially to how to determine the money supply, is that you can let banks, based upon how much they're willing to lend, determine the money supply, and then governments can try and manipulate those loans through changing interest rates, which is a system we have today. So my message is that there is nothing wrong with people deciding to charge interest off their money, people deciding to lend their money, people deciding to borrow, but combining the process of money creation with borrowing is a disastrous Ponzi scheme that can only lead to bad effects and reforms that need to fix those broken systems.
Okay, so the next question I have.
The question, what happens to personal indebtedness? You can still have loans. The current system, the way that it works is if you default on your loan, the money supply shrinks. So that means there's less economy, the money supply is just destroyed if you default on your loan, because it wasn't borrowed from anyone in the first place. It was just created upon issuing the loan. So it means the bank doesn't receive its interest and the money gets destroyed from the economy, which then creates a deflationary effect. The fact is you can replace that money with another form of money, a debt-free money, and then debt-free money can be lent from people that are actually looking to lend that money, as opposed to the bank deciding it for you. Or it can be put in investment products just like it is today, but instead it's built upon a sound debt-free monetary system with competition from fixed money supplies like Bitcoin. That's where I think we want to be. And I think these are the types of reforms that we can get from situations like we are in.
Cool, thanks for that, Simon.
But also remember, sorry, I
was just actually thinking, is he finished yet?
When you take out the massive amount of waste from the economy on servicing interest to pay banks, when you take that out, rather than actually that being redistributed through a peer-to-peer system, rather than having skimming on top, you can have a really big effect on people's ability to save and not have to necessarily get in debt in the first place. By having a money supply that's independent of the level of indebtedness, you can actually determine the money supply. And then if you take out a lot of that wasted interest by combining it, then you actually have a situation whereby people borrow maybe for productive reasons in order to create things, in order to do things, rather than actually, the situation that we have today, where it's borrowing for survival.
Just making sure that you're done. Are you actually done this time?
I'm done.
Okay. Okay, so the next one that I have is actually quite a long thought, I guess, and they're just asking for what your thoughts are on this. So one major benefit of fiat is institutional backing. So they gave an example. I recently had a fraudulent CC charge and was grateful that I could call my CC company, who reimbursed me with no resistance, and with hacks and internet being risky. How can Bitcoin thrive with no safety net? So I guess that's the question around, is like how are we safe with Bitcoin not being centralized and not having a backup or a safety net, basically?
Yeah, so this is a belief that we have to have an either or scenario, and we don't have to have an either or. I believe that Bitcoin actually in the end makes fiat currency better by creating competition. So when people can exit the traditional financial system, then I believe that the fiat currency creators, the central banks and the private banks, they need to create better versions of their currencies, because when people can exit us en masse, to things that operate outside the financial system, then Bitcoin is a form of regulating regulators, essentially. So it's not an either-or scenario. It would just be appropriate forms of money for appropriate types of things. So with your everyday expenditure, Bitcoin is irreversible if you're using it. It comes with responsibilities. The responsibility is that there's no central party or authority. So when you use PayPal, you have these scenarios where, because of the way the chargeback system works, PayPal, if somebody commits a chargeback on your PayPal account, then they have to hold the money for 6 months, and therefore you can't access as a merchant your money for 6 months, because any time during that 6 months period, an arbitrator could decide, and they tend to favor the consumer, and the consumer then can get their money back. And there's nothing wrong with that system. That is just the way that system operates. If you want to operate off a system whereby all of the funds you receive are final, then you have a finality situation like Bitcoin. Now, that's not to say that companies can't come along and build on top of that protocol and create reversibility into people that want to use a service that has reversible Bitcoin transactions. So if somebody wants to create the exact same credit card system on Bitcoin, then they can actually sit in the middle, create a company or a service whereby they are the arbitrator in the middle. You can have a multi-signature transaction whereby you are party to that transaction and other people are party to that transaction. And if you want to operate off the same system, many people wouldn't want to, but if you did want to, then you can just do the same, recreate the same thing, but built upon on top of Bitcoin as the underlying asset that's being transferred and escrowed. So you're absolutely right. If you're in a scenario where you want to reverse your transaction, then you should be using credit cards and debit cards for those types of transactions. If you want to be in an irreversible scenario, then Bitcoin is one way of doing that. And then there's essentially just different types of payment systems for different types of transactions that you want to operate within. There are some times when the irreversibility is what actually makes it, that there is no central third party, and then there are other times when you want the third party. In terms of hacks, it's another important thing to appreciate. That it is you being hacked as opposed to Bitcoin itself being hacked. And obviously that is a real risk. People need to protect them. One thing that I've experienced is that those that own cryptocurrency, because they have financial transactions on the line, tend to be learning the skills that everyone in a modern day economy must learn. Everybody in the future needs to learn how to take personal security more, take it more seriously. If most people are still using the same password for multiple services, they're not using two-factor authentication, or if they are, they're using SMS two-factor authentication, which could be manipulated by the telcos, or a hacker changing your SIM, doing a SIM swap. These types of skills are not just things that everybody needs to learn in the future. We are in a digital world, and therefore everybody needs to know how to take care of their personal security. And there's simple measures you can use: unique passwords for everything you do through password managers, using two-factor authentication that's not dependent upon SMS or a telephone company. Using all of these things, everyone needs to do that in the future, using your Touch ID, using various other pins on top of passwords. Everybody needs to do this. Now, I'm not sure about you, but when I try and log into my online banking, it's just as hard as trying to log into a Bitcoin wallet. You've got to do all these different processes because fiat money is subject to the same types of issues. And it's just a reality that entrepreneurs need to create better user experience to make that better, but also individuals. Everything is going to be hackable in the future. Your personal identity, your private messages, your personal photos, these are all hackable things. And what I found is that people that are in the Bitcoin industry or the crypto industry, because there's financial transactions on the line, they tend to learn these lessons of how to take care of your personal security a lot faster. because they need to in order to do that. So it's pushing the trend in the right direction of personal responsibility, because the reality is we are in a digital world, and the digital world comes with consequences, and those consequences are invasion of privacy and hacking. If we want to reverse that trend, then you need to live in an offline world, in a cash world, with no connection to the internet.
Yeah, Simon, that just made me actually think about a few fears that some of my friends are talking about, and like what happened with in Greece and Cyprus, and people had savings, and that the money just went. And like, I don't know if this is a comparable, but like people's wallets getting hacked it's almost kind of like the same thing as what the government does with people's bank accounts. Like, they just take your money. That's a hack. Is it comparable?
Yeah, so there's two types of hacks that can happen in the fiat monetary system. There's a government created hack, which is essentially a bailout, which is where the bank takes too much credit risk with your money. Because when you deposit your money at a bank, they own it, they can spend it, and the governments can inflate it away so that you have to invest in order to try and beat inflation. The type of hacks that can happen when the banks get reckless with their lending, like they did in 2008, and like the governments encourage them to do, to lend more money to property to prop up the market so that they can win votes at their next election, then you end up with the government bailout effect, which is essentially, rather than you losing all your money because they took too much risk with your money, the government essentially pay for that, bail out the banks, keep the bank alive. And that's something they have to do under the existing system. If you think a bank can go bust, there is massive consequences to banks going bust. It's not a desirable thing. It's not something we want. It's not something a Bitcoiner should want just so that their Bitcoin price should go up, because it's a really nasty thing. So there's a government hack there, and then there's also a bank hack, which is a bail-in. So they could just decide, laws have been written to make bail-ins easier and easier, which is essentially, because the money isn't yours when you deposit it at the bank, they have full entitlement and full right to use it like they did in Cyprus. So we've got different case studies of all these things happening, because so these are bank hacks and government hacks, and the same thing can happen with Bitcoin, but you have your own personal responsibility, and then you need to use secure methods to store those, because people do want to steal your things.
Yeah, so the next question that I have actually follows up nicely with that. It's about credit card loans and bank loans. So if the banks do go bust, then how do we actually pay that personal loan or bank loan or credit card loan back?
So when a bank issues a loan, what technically happens is they issue an asset and a liability on their balance sheet. Sorry for getting geeky, but I think it's important for people to understand these things, because they often shy away from finance. So essentially what they're doing is they create an asset, which is that they have something that pays interest, they can receive interest on. They also have a liability because they owe you that money. And this is the double accounting that happens when you borrow a loan at a bank. An asset and a liability is created, the two match each other up, and essentially that's the way that new money is created within the private banking system. If for any reason anyone defaults on that loan, then that money disappears, both the asset and the liability disappear, because they can no longer collect interest on that money, and they can no longer, they don't have that asset which is collecting interest, and they don't have the liability to hold the money in your name, essentially. So when banks do this and they create their assets and liabilities, there's two forces that remove that asset and liability. One, you repay the loan. If you repay the loan, the money disappears, and the bank needs to find someone else to borrow the money. And if you default on the loan, then the money disappears as well. So if people stop paying, then that is essentially a loss on the bank's balance sheet, because the asset and the liability disappear simultaneously, either if you repay or default. So defaulting on a loan just means that if the bank goes bust, they no longer, whatever the traditional liquidation proceedings of unwinding that is, but most people won't be repaying those loans to a bankrupt bank. It's essentially the risk of being a bank.
Okay, thanks for that, Simon. The next question I have here is, do you think mining capitulation could cause Bitcoin problems, especially with the halving coming up? Could it become too expensive to mine and cost ineffective?
Well, fortunately, Bitcoin figured out in their algorithm that this would actually happen, and they implemented called a difficulty adjustment. And the difficulty adjustment means that whenever too many people are mining and it doesn't reflect the business model and the cost base, then people switch off their mining equipment. Other miners go bankrupt, and it moves towards the most efficient miners, and the difficulty rate adjusts, which means that it becomes easier. So we have been through cycles like this many times. So as I said in the last video and other videos, I've seen my Bitcoin crash from $30 to $3. We were a lot less, we've operated the Bitcoin network of a lot less security. Right now, Bitcoin is the largest supercomputer in the world. And it doesn't necessarily need to be that much hash power behind it. And the market forces will adjust. It's a free market here. The least efficient will go bankrupt. Those that have done the most level of innovation will be able to operate, and the difficulty rate adjusts so that we don't end up in these scenarios. But never say never. But from what I've seen, these adjustments and forces always work during troubling times and market corrections. And I've seen this many times before. Seen my 30 crash to 3, seen my $1,250 Bitcoin crash to $250, and I've seen my $20,000 Bitcoin crash to $3,000. I've seen a 90% correction in Bitcoin in one day. So the market always adjusts, and the way that the algorithm was designed is it tends to factor in these forces.
Actually, that reminds me, because we spoke about this. Well, I guess we touched on it on the last live that you did, and people who don't have the money to actually invest in Bitcoin, even though the price is lower or might be lower, and in the case that mining is cost ineffective, or some people just won't be able to mine. What's the recommendation on how to actually get yourself into crypto, get crypto?
Yeah, mining is institutionalized. It's not something that people can do anymore, unless you're looking at way more speculative things than Bitcoin, in which case you're looking at a different risk profile there as well. So Bitcoin mining is not something that it's just not even a recommended way to do that. Look at Bitcoin mining companies. It's an institutionalized business. So I wouldn't say mining is the right way to do that. If you do have spare cash and you want to hedge yourself, I can't give you financial advice. You need to understand the risks you need to be in a position where you can handle the volatility. But remember, volatility is only the concept if you're going to be converting it into the fiat currency. To me, I see volatility in the fiat currency because, if I was to sell my Bitcoin, I'd have to buy fiat, and then I'd have to be at the mercy of not owning my own money, not being able to spend my own money, and hyperinflation, quantitative easing, and all the intermediaries that sit in the middle. And I might be lucky to spend my money one day if they agree that I'm spending it in the right way, if I provide all enough proof and documentation to allow them to access the money that I now gave to them that they own. Is essentially the way it works in the fiat system. But if you do have enough reserves, and there's ways of buying that. But the other thing is, look, I can't give you a course on how to survive in the current environment, but there's never been more opportunity for people to create their own side projects and their own side gigs. The fact is that we are open with the internet to a global workforce and global opportunities. If you want to create your side gig and only accept Bitcoin for your services, I think earning Bitcoin is a really great way. And then once you have value in Bitcoin, you tend to start learning how to secure it, and then you start learning how to store it. and then you start learning the different things. So personally, I think and anyone in that scenario should be innovating what type of side gig can they do to earn Bitcoin. Maybe they, you either buy it, you mine it, or you earn it. What's right for you, what's right in your situation, is kind of understanding your personal situation and your personal strategy, and think a bit more longer term.
One more question on that, Simon. Do you think that there might be something in the future that's innovated, a new innovation of how to get yourself some Bitcoin, other than the options that you've just mentioned?
Well, that's essentially, a bank to the future. That's what we do. We invest in entrepreneurs that are creating innovation to allow people to make onboarding into the alternative financial system easier. And there are entrepreneurs all around the world and people all around the world, or joining companies. Not everyone's, an entrepreneur. Other people are more, different skill sets that you can bring. So you can join different companies that are involved in this industry. The number of, I know we're in troubling times right now because we've been off a 2-year bear market that then started to look like a bull market and then a crisis situation. But the number of people that are employed in this industry has been on an upward trend. Obviously, there's been some corrections with many of the companies that we've been investing in. But you can, there's different ways of joining this industry and joining this sector. And using that opportunity to educate yourself and try and find innovative ways of accumulating whatever you want to do. So this is, with financial innovation, the imagination is the only limit. It sounds as cheesy as it can be. The sky is literally the limit in terms of what you can do now that we've got this protocol that opens up essentially a bank in a box. Now, I don't want to sound insensitive in times like this when people are focusing on their safety. But, at some point, you're going to have to be thinking about how you can use these opportunities to do things differently, and start thinking about what you're going to do to protect yourself as a health crisis turns potentially into a financial crisis. And then many of the things that we've been forecasting on this channel. And again, I don't expect you to pick up one video, listen to me and have all the answers. And that's why we're going to be, we're committed during these challenging times to try and create as much content, answer as many questions as we can. But also on my YouTube video for over 10 years, since before Bitcoin was created, there's content of the whole journey of, me trying to help people in plain English understand some of these ginormous complexities that have been built into the jargon of our financial system.
All right, so I have a few more questions left that I would like to ask you. We have hit the 1 hour mark. Are you doing okay?
Yeah, just checking my calendar. I think I've got a meeting in about 30 minutes, so I need to wrap it up in the next 20 minutes or so.
Yeah, sure. I think we've just got a few more questions. I think we'll be done before then. Okay, so the next question I have here is, what would be the negative impact of implementing a fixed currency supply on top of the financial system over the overall economy?
Let me try and reverse engineer that question. A fixed money supply on top of the current economy is essentially what we got. What we have right now is a traditional fiat system with an ever increasing money supply as a function of debt. And we have Bitcoin, which is a fixed money supply, and people have the choice where they want to put their savings or their spending money. So, if I'm understanding the question correctly, putting a fixed money supply on top of the existing financial system is exactly what we have that Satoshi Nakamoto invented in 2008, and that we have today. And the effect of that is it gives people choice that they didn't have before.
Okay, so the next question I have here is, we need, I guess it's a comment more as well, we need to increase the direct transfer of Bitcoin for goods and services. We are all at risk when we exchange our Bitcoin for fiat. Do you have any comments or thoughts?
Again, like it's really challenging because we've converged in an environment where we have 140 characters on Twitter to try and communicate very, messages, and it's pretty dangerous to say these things like risk, because risk is a spectrum and there's lots of different types of risk. So when you hold your money at a bank, your risk is that the bank can actually bail in. When you hold your money, when you hold your savings at a bank, the risk is obviously that it will be inflated away over time and you have to work harder to add to its supply. When you put your money in Bitcoin, if you're spending in fiat money, then you're obviously taking volatility risk. If you store your money with a third party, even your Bitcoin with a third party, then you have counterparty risk. So unfortunately, the devil is always in the detail, and it's why I try to create videos, because it's very hard to express in 140 characters the meaning of what these different risks are. And everyone will interpret it in a different way. So I think I get what you were trying to say, but the challenge is, what risk are you trying to protect from? Because that will determine how you want to hold your assets and where you want to put it.
Great. Next question I have here is, do you think crypto projects will get defunded if Bitcoin crashes to $1,000?
Defunded. I think people are going to invest less. But, at Bank to the Future, we've been around since 2010. We've been through 3 market crashes. Some of the companies, they may raise less during challenging times or more. They may raise it in crypto and keep some of that crypto. We've had companies that held Bitcoin reserves for their company and never needed funding again because they rode the bull market and didn't have to sell because they had enough dollars or fiat to ride out their fiat liabilities. So I'm not seeing, these are all just the way people need to understand recession is that it's not that it just disappears, it's reallocation. So obviously money disappears from the economy, but then Bitcoin comes along with this fixed supply. And if money moves from one supply to another, then you have an increase in the price of that other supply. So it's all just reallocation of resources. If we have destruction, debt destruction, in economics, we have this concept called Schumpeterian innovative destruction, which is the destruction of an inefficient industry. Rather than having it subsidized, obviously there are industries where it's for the greater good, but the destruction of an industry like Blockbuster leads to the creation of a new industry like Netflix, which is doing things more in line with how consumers want to use those projects. Look at this recession. Amazon have just employed during this crisis a new 100,000 people. 100,000 jobs they've just taken on because everyone's trying to order their stuff when they're in home quarantine. Now, trying to pick the winners and losers in certain situations is sometimes it's really upsetting. Sometimes it's not, nice. But the one thing that is inevitable, predictable, and guaranteed is change. What we have to get our heads around, what humans find very hard, what I find hard, what other people find hard, is when you're used to something being a certain way, we have to adjust to change. And that really messes up the psyche and the human brain, because we're not very good at adjusting to change. We like things to be the way, we like to have certainty in our life. The world that my parents knew is a completely different world to the one we have today. We live in an environment of constant change. And a recession is simply a reallocation of resources, meaning that you have to look at what you're doing in a certain way. And if that's no longer working, what adjustments can you make in order to fit in with the new economy? Because with every recession, there is a new economy. With every destruction, there is a new creation. With every crisis, there is a new opportunity for people to create new opportunities, new innovation. And that's where I think people should be focusing their energy, because we can either just focus on the complete destruction, or we can do something more empowering, which is what can we actually do, what value can we bring? And change is inevitable. It's something that we as humans find very hard to adjust to. But if the financial system is changing, then you either go down with it, or you decide to go with the new, or you hedge and you protect yourself, because there's, and that's I wish that there was a simple answer. Just give your money to a financial advisor and they'll figure it all out for you. But there isn't. There's just personal responsibility now. There's you deciding, what you're going to speculate on, or you decide that I'm ill-equipped to speculate and I'm going to give it to someone else to speculate for me. And if you give it to someone else to speculate for you, then you're removing the personal responsibility and giving the responsibility to someone else. And if they get it wrong or right, then that's at the mercy. That's what the pension system is. That's what in the insurance system is taking your money, giving the responsibility to somebody else. And because I know you want to focus on exactly what you want to focus on, which is what you're good at, whatever your skill is, whatever the value you add to the world, whatever your job is, whatever your career is. But everybody needs to have a side gig, which is protecting their finances as well. And that's just the reality of the world that we live in today.
Cool. I actually have one last question for you, Simon, and I think that'll be it for today.
Okay.
So I guess this next question is about in investing large amounts of fiat. So investing for a large amount of Bitcoin, would that flag up with banks, and can banks just like seize your money just because you've invested X amount, like particularly around the crisis now, if somebody decides to like invest a large amount in cryptocurrencies, what's the risks?
So yes, there is a great deal of uncertainty from the traditional financial system. That has always been a reality in the Bitcoin industry, whereby, but that's got so much better over time. I don't want to reveal too many details, but because I don't, it's just not a good idea in a public forum. But there are banks out there that are ultra innovative, that are fully embracing. Like there's a bank that we operate, that we use. They operate off as much as they can a full reserve system. They will allow you to transfer your Bitcoin in and out. And they're embracing the scenario. There's a lot of innovation happening in Germany, where banks are getting into the crypto industry to make it easier to go in and out. But yeah, there is a reality that certain banks, if they, they'll try and protect their system for as long as they can. And if they're fearful of money that's come from the crypto industry, then you need to be with a crypto-friendly bank if you're transacting in large sums. But then, this is the use case of crypto, which is that as long as, one of the tips that I can give you is that if you're at some point, which everyone may do or may not, depending on how the economy goes, if you're taking your crypto and you're trying to get it back into fiat, then just make sure you've got an audit trail, that they weren't the proceeds of crime, that you have an audit trail of your source of wealth and source of funds, because the banks they're subject to anti-money laundering laws. So are we as a business, as a securities business. And therefore, the more you have the audit trail of your paperwork, that you earn those through legitimate sources, as long as you can provide that paperwork, then you just need to be with if you're going into fiat, you need to make sure that fiat goes into, if it's in large sums, like when you're doing at the micro level, you tend to get less problems. But when you're dealing in large sums, just make sure you've got your audit trail to show that you earn that crypto or that wealth through legitimate means.
Cool, that's it, Simon. I think we're done for today.
Awesome. Okay, so thank you very much again for Famida for bringing out all the questions and condensing those. As I said, our goal during this period is to really just be of service, to be of value, to try and help you gain more understanding, to try and give some commentary, and that's what we think we can do during these challenging times. And if you've got any suggestions for us, then please do just comment on this video, use the live chat, let us know what other things you'd like us to comment on, and let us know what you're up to, what you're doing during these times when you might be sad at home. Maybe it's a time for critical thinking and you've coming up with interesting ideas and interesting solutions. I think that's what we need. You know, I know some people that are actually doing things like putting together conference calls with all their friends that are sat on their own, and playing virtual board games and things like that, and doing all sorts of interesting things to try and you know, use this time to do something that adds value and helps people in these scenarios. And who knows, you know, we may be in a scenario where we've all you know, overreacted. Essentially, we're not sure. We don't know what the scenario is, and this might come under control. But stay safe, be precautious, and you know, don't let this consume you. Don't let fear consume you. Use fear in the right way. Use fear to make sure you're precautious, that you're not spreading an infection, and that you're taking the right measures. But don't use fear to consume you into a state of you know, not being able to do anything. Use it for the right way. Channel that energy, and you know, if you can add value to others, you'll probably find it more rewarding for yourself. So those are my philosophical thoughts at the end of a financial talk. And thank you all, and let us know what you'd like to see next. Over and out.